That's a very good question. Now, before we jump into that, I just want to talk about why pensions are such a great vehicle. So you get tax relief on your contributions if you're making personal contributions up to 40%, and you can make company contributions where you save on corporation tax because it is a tax deductible expense against your profits. Now, for limited company directors who own a property portfolio, it's great because they can then use surplus money in their companies to make pension contributions. That saves them 19% or even greater corporation tax. In addition to that, if you think about it, you've drawn the money out of the company and you've saved on the dividend tax of up to 38.1% as well. So these are great vehicles to extract profits from a limited company. But if you are a landlord who holds the property in individual names, then it works slightly differently. Rental income does not qualify as relevant earnings for a pension contribution. So you can only contribute to a pension up to 100% of your relevant earnings, which is typically your earned income. So if you are a full-time property landlord, then your contributions to a pension are limited. But thankfully, there are other vehicles which can be used in a similar way to pensions. These are vehicles like enterprise investment schemes and venture capital trusts, specialist investments, but you get up to 30% tax relief from the government. So the key here is to consult an advisor, an expert like me, who is able to look at your situation and then advise you on the right combination of vehicles, because often it's not just one, it's a combination of 2 or 3 different tax efficient investments to get the outcome you want. Hope that answers the question.
I think it's useful to add to that actually pensions provide a great way of mitigating tax, but not necessarily resulting in you having to part with cash for too long a period. So especially for those people that are approaching retirement, it's really worth considering ramping up your pension contributions, because with flexible drawdown nowadays, there's means to access the cash in a relatively short period of time. And especially those that Rohit mentioned relevant income. Well, actually, even where people don't have earned income, they can still contribute up to £3,600 per year gross, which works out to be something like £2,700 net. So the taxpayer parts with £2,700. HMRC will put another £800 into the pension scheme or whatever the figure might be, there or thereabouts. So now you've got £3,600 in the pot for that tax year. Then if they're approaching retirement, they may find that actually they can definitely access 25% of that cash tax-free, bearing in mind that they've already got 20% tax relief on the way in. And then if they've got no other income, they can use their personal allowance to take even more money out without having to pay any further tax. So these small wins can actually amount to quite a lot of money for people that don't actually even have any relevant earnings.
Yeah, no, very good point, Raj. So pensions can be accessed from age 55 currently. From 2028, it goes up to 57, but it's still relatively early. And they're also a great way of passing wealth tax efficiently from an IHT point of view, because when you pass over pensions and after your death, there's no inheritance tax applicable on it. That's the other advantage.
The other scenario where we've used pensions quite a lot is where people own commercial property in their limited companies. They may wish to consider making pension contributions and allowing their pension scheme, their SIP or their SAS, to purchase the commercial property from their company. And through the process, what ends up happening is the company gets corporation tax relief on the payment of the pension contribution. It does suffer corporation tax on disposing of the property, but if done correctly, you can balance those two out. And then you've ended up with the commercial property being in your pension scheme. And as Rohit says, well, it's in a great IHT-friendly wrapper, because you can pass that down to your beneficiaries without having to pay inheritance tax. But also the income generated from the commercial property is free of tax as well while it's in the pension. And in a lot of cases, the commercial properties used by the business. So the payment of the rent qualifies for corporation tax relief as well. So it's a win-win for the taxpayer in that scenario.